Hi, this is Stefan Smit from SS Invest, and in this video we'll be continuing on from where we left things in our asset allocation overview video. We will now discuss the different approaches to asset allocation, starting with the composition of a long-term investment strategy. Strategic asset allocation forms the backbone of any good investment plan and is based on your predetermined risk profile. The allocation is determined by a combination of how much risk you can assume and the minimum return on assets required to meet your long-term investment goals. Some people think that an adaptable strategy is the better option, especially considering our economic cycles and the political influences that normally determine market direction over the short term. Most often than not, you'll find that where these aspects form the basis of strategic allocation shifts, it's most often driven by fear that's fueled by improper investment advice. As explained before, one of the most important considerations in determining your risk profile is your investment time horizon. Understandably, investors with longer time frames can afford to take on more risk because they have time to ride out market volatility as opposed to investors with shorter investment time horizons. If this is properly considered during the investment planning phase, the strategic asset allocation will be easy to understand and referred back to during times when markets fall apart. Of course, there are factors that may change your strategic allocation, but these include drastic events such as a large inheritance or the death of a spouse. In the absence of such an event, the long-term strategic allocation should very seldomly be changed or altered, especially if it was determined correctly at the start. This does not mean that investment opportunities should not be exploited when they pass by. This brings us to tactical asset allocation. As the name suggests, this approach is based on a plan that's designed to complement the existing strategy and exploit favorable market opportunities when they arise. This may include an increased portfolio exposure to rand hedge companies following periods where there's an abnormal strengthening in the currency. Whatever the case may be, the main takeaway is that this allocation is temporary in nature. The weight is normally small and also risk profile dependent. This approach is sometimes referred to as the core satellite approach, where the long-term strategy or core is orbited by smaller interchangeable allocations or satellites. For more information on the topics discussed here in this video, please visit our website at www.ssinvest.org.za or find us on Facebook or LinkedIn. In our next video, we will discuss everything related to rebalancing your investment portfolio. Thanks for watching.